I'll tell you how to be a profitable trader, just don't be disappointed. We've been profitable traders for 9 years now, and in this episode, I want to tell you how you can become a profitable trader as well. I can tell you that it's not difficult, it's not a secret, and it's not something mystical that you develop after hours of screen time. It's actually kind of boring. So if you want, Padma, let's go with the first point, and then we'll go from each point to kind of tell you how you can become profitable as well.
The fundamental thing about it, the initial step is to find something that you can do, that you can make money, right? Like any business. You find a product or a service that you sell, and you do that consistently and at scale. In trading is the same. Like you need to find an edge or take risks that others don't want. That's the two main ways you can make money. There's other ways, but for the context of this video, that's what we're going to talk about. Finding an edge is, perhaps we can start there. So finding an edge is, we talk a lot about in here, is finding something that other people don't know, either informational advantage, operational advantage, whatever way you can find that you have an advantage over your competition. These are usually hard to do, and you have to go places where, if you are an average retail trader, you have to go places where the big players are not trading at, or are not there, or aren't willing to go because it doesn't have the capacity that would make it reasonable for them to go. Example is like microcap equities, niche markets within crypto, going to new exchanges that are being developed, new protocols that are that have not dissipated, but that have liquidity that is not yet aggregated with the entire market. Very niche stuff that you can do, that you can find an edge on. Or the second option is taking risks others don't want. So stuff that you find in a backtest, risk premium, stuff that is very well known, that you know exists, that most people exist, but they are still working for a reason. And they're usually working there for a reason because other people don't find it interesting or economically viable to arbitrage it or to arbit away at capacity, right? And so that's why it's still there. And those are the two business models that we run, and that works for us.
Yeah, completely. I think also main thing I want to hit home on this first point is that a lot of people do actually find things that work, like risk premiums, for example. A lot of strategies I see are basically trend following strategies, but they do two main problems. One is they try and find something that's going to completely outperform by like 5x. You're not going to find that with a risk premium or even really with an edge most of the time, unless you're taking on a lot of other risks or it's like a very small capacity edge, for example. And then two is most of the time they want to increase the amount of trades it's taking just because they want to be trading more, which they think is going to be making them more money. So they'll often take a really solid risk premium like trend following and then try and apply it to a 1 minute time frame where there's way too much noise, it's going to be way too many commissions, and it's overall going to be unprofitable. A lot of the time these risk premiums are boring. You have to take them on a daily time frame or a 4-hour time frame. They're going to be a bit slow. You're not going to get a ton of trades. You're not going to be outperforming SPY by 50%. You're going to be overall slightly above average. It's still going to be a good risk premium, but it's not going to be something that's, what I think a lot of people expect out of trading is that you're going to make 5x your money in a year because you find one particular thing and it's because of this pattern and that's why you make so much money. A lot of it is more boring, and being accepting of that fact means you can slowly build up a portfolio that can do more, like a lot better over time. But that will be one of the kind of later points. If you want, do you want me to take the second topic or you want to do it?
No, go for it.
Sure. Okay. So once you found an edge or a risk premium that you want to do, you have to systemize it or operationalize it. So basically, it's quantifying the particular logic. For risk premiums, most of the time, this is pretty simplistic to do. So for example, if it's a trend following, it could be something as simple as a moving average crossover. It could be the daily time frame bouncing off a moving average. It could be momentum score. It could be anything you really want it to be, as long as it's based on the principle of that particular risk premium. So most of the time in trend following, what that means is it's going to be a lower hit rate. So you'll normally be winning 30 to 50% of the time, maybe even as low as 20% of the time. But then you'll have an average R, which is like risk to reward, often above 3, above 4, give or take, because you'll be losing a lot of times for, let's say, 1R, and then a couple of trades will make you 5R, 10R, etc. And that's kind of compounding over that time. For opera or like quantifying edges, these can sometimes be a bit more harder to do. It really depends on what the edge is. Some edges, for example, let's say you find an arbitrage, that's very easy to quantify. You know you're buying something cheaper in one place and selling it more expensive in other places. Or another great example is like, let's say there was a huge funding rate arbitrage, something like that. That's quite easy to work out the math and understand it. Other ones are more difficult. I'm trying to think of what one would be more difficult to like. I think small caps would probably be one of the harder ones to quantify if it's a unique edge in small caps. For example, if you detected that there's a lot of large buyers that enter in at like 10 p.m. or like 10 a.m. for example, and for X reason it pushes up the price by X amount because it's made by X investor or X company, and they always do similar price action. That could be potentially an edge, but it's a more harder to quantify. But there are obviously better examples like way there you can always kind of quantify them. Is there anything you kind of want to add on that?
Yeah, and in terms of the operational side of it, other than quantifying the signal and understanding what kind of bets you are making there, you have the whole part of operationalizing your business, right? So, for example, when you set up a store or any traditional business, you have like your employees, everybody working towards the same goal, and then it becomes like if you're on a scale, it becomes a business of volume, right? Of pushing even forward, even more on marketing or whatever it is of your business. And the operational side of trading is exactly the same. Is okay, you have this edge that you edge or risk premium or whatever that you are exploiting. How can we trade this at capacity? How can we move on to other edges? How can we add strategies to the portfolio so it becomes a bit more robust over time? How can we trade different exchanges, different markets? There's a bunch of questions there that once you start scaling out of the first initial models, you want to start asking yourself, and then it's building the infrastructure to accommodate for that, right? And that's the part. That's the part where you start to operationalize your trading business, and it can get quite complex, especially now that we are working on it as well. We are getting very deep into these topics, and it does become a problem. But it's an important step. You want to operationalize all your business, right? So
Yeah, completely. I definitely agree. I feel like that kind of gets, I guess, onto the next point around like executing daily or executing
yeah,
your strategy kind of perfectly. You've got different ways to do this. Obviously, you could execute manually, which is, I think, a great way to start. I wouldn't ever push anyone away from just, if you have no coding knowledge or you don't want to hire a developer, just execute it manually for now and see how and test it out. But I would say if you do want to become more systematic, the natural progression to that is automating the strategies you can automate. For example, like most risk premiums, you can 100% automate. Sometimes if it's an arbitrage, you're not going to have enough time to automate it, so it doesn't make sense to. But if it's something where you're going to be taking 100 trades, 1,000 trades, etc., definitely worth to automate that, especially if you want to add more strategies after that, which will kind of be our last point. Main thing around execution as well is this is where most people, if they've been trying to hyper optimize their strategies in the kind of first step or the second step, this is where you'll see them fall apart. Because let's say you've tried to apply it on a 2-minute time frame and it's taking tons of trades, you'll now have to experience the slippage, the commissions, spread. If there's maybe you're pushing too much size onto it and it's a very illiquid asset, all those sort of things will bite into your profitability and ultimately make you unprofitable because that strategy will no longer work when it's actually live. So that's why, like, while it is boring, sticking to, I would say, daily timeframes as your first sort of strategy, I definitely recommend. I know it's the thing no one wants to do because when I started out, I started with lower time frame strategies as well. But after so many years, daily timeframes are definitely one of the easiest things to at least get up and rolling, and you're not just losing a ton of money. Obviously, you still need to apply risk management or the other kind of common sense factors here, but it is a place where you can find a lot more working strategies than something intraday.
yeah. You want to start with the simplest possible solution to get you into the market right away, right? And the lower the time scale that you go, I don't even mention like time frames, but the more that you have to execute, the lower time frames that you go in this case, the more competition you'll find and the more trading will be costly. Imagine this, right? You are doing a business that every action costs money to do, costs money in various ways, and you want to do it more frequently. What does that mean technically? It does mean that you need a higher margin higher margin on that edge. You need more edge because you have to overcome a higher burden in fees. And that's really hard to do when you go lower and lower the time scale. There's teams competing with lower exchange tiers that they give them to make volume. You have a bunch of disadvantages on a competition scale that it's really hard for the retail to compete in those timeframes. It's cool to see on TikTok, like people trading Forex on 1 minute time frame, but it's not real, right? You want to be trading like real edges or harvesting risks that others don't want to harvest because it's not competitive for them as a retail trader, and start there. Not try to do the complicated stuff. 80-20 solutions is the way, in my opinion. And if I may add on the execute daily section, trading is pretty boring, right? You just once you have everything operationalized, like we talked about in the previous point, it's just coming in every day and sending orders to an exchange. Or if you have an automation, just making sure that everything checks out, right? Trading is boring. It's not like in the movies, oh, you go and you take like 2008 position, like a position on 2008 at the top on full leverage, and you go to banks and you ask for credit swaps. It's not that, right? That's not real trading on a day-to-day basis. Trading is boring, and it should be. If you're getting too much emotions, and I talk that from my side, there's times I'm very excited about trading or very sad. Those are the worst times. Those are the times that you are doing something wrong because you are trading for that thrill and for that gambling, which is fine. You can do that on a different portfolio, but usually good trading, good long-term trading is operationalized daily, doing the same things.
Completely agree. Like there will be sometimes there's exciting periods. Like I remember for us, the meme period was a bit exciting for us, but that's also probably where we made some of the most mistakes. We were still able to capitalize on some of them, but 100% over the years I've been trading, the times where I'm most excited or most emotional have always been the worst for execution and just overall for kind of like P&L in general. One thing I do want to know, I already can see the comments. I can see someone typing, well, give us the exact strategy you like actually want to trade, right? If you want to become profitable. There's two things I could kind of relate to that somewhat work, I think, still now. And first is kind of a risk premium, which is a basic trend following, and that would just be a breakout strategy. Now, breakout strategy can be as simple as you'd like. It could be, entering above the 30-day high. It could be a particular indicator you're using to detect a breakout. But breakouts have conditionally worked across equities, crypto, even futures. Now, keep in mind, where they'll make the most money is the more inefficient/volatile market, which at the moment is primarily crypto, but it still can work amazingly in equities recently. Like there's been a lot of strong breakouts. And then two, if you're looking for something that would maybe classify as an edge, I guess it's slight alpha, would be new listing shorting for any new listing on like Binance, for example, or other main exchanges. Normally, if you kind of look at the data, most of these new listings will have a lot of volatility the first 3 days. After the first 3 days, most of the time, that volatility drops and it's quite an easy short and it will just kind of continue trending down. There'll sometimes be bounces here and there, but as long as you're doing position sizing correctly, it can be quite a good kind of short position, especially on a lot of these new listings on Binance. Normally, the holding period is about 20 days total to 30 days because a lot of the time market makers have contracts around that kind of time period for those kind of newer listings that don't have that much volume. So you can normally take advantage of it during that time. I think those are two like great examples of where you can look into something today. You can actually test it quite easily. Crypto data is free to kind of pull up if you want to just pull some data using Python or anything like that. And you can get going with very small size and just test things live. Just to end this off with like one small thing is I recently talked with a trader, incredibly smart. I think he had a master's and everything, but he'd been working on just backtesting for 2 years. And I was like, why have you not put anything live? Like 2 years is a crazy amount of time to just be testing things historically. There is definitely value in backtesting, 100%. I made a whole boot camp around it, but you should be putting things live. You should be testing with small size, even if it's with $100 and you lose $20, $10, whatever. You learn a lot by putting things live, and then from there you can build up momentum.
I'll give a quick example on that. I completely agree. Because people look, research and building models is the easy part. It's easy. Today, you can build like a model, go on ChatGPT and ask it to take data from Yahoo Finance and test a signal. That's easy, right? What's not, sorry, I want to rephrase that. Like it's easy to get a simple backtest. Once you get into more complicated stuff, it gets quite quite complex, quite fast. But if you wanted to take like data for SPY and test a simple signal there, you can get that data today and do that. But the hard part is going into the market. Like I was talking with Munir last 2 weeks. We've been talking about the new strategy for a new market that we've been developing. For obvious reasons, I can't say what it is, but I'm going to keep it broad. And I went into the market and I started a $10,000 portfolio or something like that. I published on Twitter, 10,000, just to test out the size, like just to test out that market, if that inefficiency that I was seeing was real, if I could harvest it. And what ended up happening was an interesting thing. I actually found something else around that trade that I could be doing that would be much more efficient and would probably make more money over the long term. All because I just went on that weekend. It was a Saturday. I went into that market and I started playing around with the sizes there. Just that. If I got stuck in back testing and modeling for 6 months, that probably would have been gone, and the juiciest part of the edge would have been gone. So get in there, get in the order book. Obviously, this is not financial advice. You do what you want. But there's nothing more real than practicing and getting real feedback from the market.
Completely. Well, I think we've lived up to the title. I just hope people aren't too disappointed. It's a bit boring to be a trader, but it's definitely the easiest way I think to go is to take advantage of risks and get paid for them.